So what is a ratio call diagonal and what is the benefit of this strategy? So what is a call diagonal? A call diagonal is essentially buying a long dated call and selling a shorter dated call. Why would you trade such a strategy? Well, the advantage of it is that the long dated call that you buy usually has a smaller theta, and the shorter dated call has a higher theta. So that means the passage of time will incur you in a credit. So you are winning money if the product does not move. What is the drawback of it? The drawback of it is that, as you can see, when price increases too much, you also start losing money. So not only you have the risk to the downside since you are buying calls, that is natural, you also have a risk to the upside if the price moves too much in your favor. What I do trade are ratio call diagonals. This means you buy the long dated call. Usually I look to buy about 70 delta calls, at least 90 days out, depending how I'm looking at the position. Sometimes if it's a breakout strategy, I'm looking at something like 70 to 100 days out. If it is a longer term conviction position, more based on the fundamentals, I'm looking at least a year out or more. And then you sell shorter dated calls against these long calls that you have. Usually, I sell about 30 deltas with 15 to 30 days to expiration. How does this change from a standard call diagonal? Well, you have all the same risk to the downside, but the difference is that your upside profit potential is now unlimited. How do I look at this? Well, you want them to be at a ratio. Usually I buy 3 longs for 2 shorts so that you can have uncapped profits. You absolutely do not want to be in a situation where you are too correct and the price keeps dragging higher and you are starting to lose money because you are too correct and the price moves up too fast. That needs to be avoided. So for that, you need to uncap your profits by being at a ratio. I also like to structure this with a positive theta. So that's usually a requirement that I look to open. So you have here an example on the SPY. We're selling 2 calls for January 13. So that's about 16 days out. And we are buying 3 times 1 year calls, about 80 delta, 635 calls. You can see if we have this position, even though we have 3 longs for 2 shorts, we are getting $9 per day of delta from this position. Our profit potential is unlimited and our max risk is the price of the calls that we are paying for. Obviously, this will need some regular management as your short dated calls will get close to expiration. You'll have to roll them out. How I usually look at it? Well, I usually look to roll them out and up so that we can keep uncapping more and more profit. The more you roll them up, the more profit that you uncap and the more profit potential that you have. I will show an example in a couple minutes. I want to break down a trade that I currently have open a little bit into more details. So that's a trade in EEM, Emerging Markets ETF. On January 5th, EEM broke out of about a 3-month trading range where it was trading in between 52 and 55. I usually set an alarm for this type of situations when these products are trending in the range bound level. And you can see here, as it broke out, I entered in a position. I bought to open 55 calls, so that was about a 70 delta, expiring at April 17 for a total $993 debit. I usually open my ratio call diagonals, both the longs and the shorts at the same time. However, in this situation, since it's a breakout trade, I also like to open just the longs first, and then as the breakout stops or stabilizes and the product starts to consolidate, I then add my shorts. Why I do this? Because there are situations where it breaks out and it just keeps breaking out higher and higher, and then if you already have your short calls, you need to start rolling them out really soon and you cap your profits more. Of course, there's the risk it rallies back down and you have to close, but I think overall it's something that I like on the breakout trades when we see I open first my longs, and then as the product stabilizes, then I add my shorts. So that's what I did here. Then on January 8th, as you can see, it rallied on the 5th, it rallied on the 6th, it rallied on the 7th, and then on the 8th, it had a red candle, it closed lower, so I felt, okay, it's time maybe to add some shorts, to cover a bit my downside potential, to start getting some credit out of this. So I sold to open 58 call, 30 delta, January 23rd, so that was about 15 days out for $56 credit. So if we look at this position, as it is right now, you can see here I bought to open the 3 calls, then I sold to open the 58 2 calls. So that's the position I'm simulating here. This is the performance profile in interactive brokers, and you can see how it will perform at different levels. I always like to simulate these when I'm making this type of complicated strategies like ratio call diagonals, so that we can understand how your position will move depending on the underlying price movement. You can see here that I have a small theta, and I have significantly positive deltas. This is not a theta play, this is a breakout strategy. I bought relatively short dated long calls, as you can see, because I'm not looking to hold this position for the long term. I'm looking to hold this position while it's grinding higher. When it starts to stabilize and does not grind higher anymore, I will look to close it. For the moment, this position is at an interesting level. I have my stop loss at about $55. As we can see here, $55 would give me about a $400 loss. And on the upside, to get a $400 profit, we needed to move about 60. But this is not the type of position also right now that I'm looking for a super high continuation up. I'm looking to trade and keep rolling out my short calls and collect some theta along the way. What about management? Well, managing these trades is critical. These trades are not open and then set and forget. They need regular management and very active trading. So an example is FCX trade that I opened by buying 48 calls, 70 delta on March 20th, and I sold at the same moment 55 calls for January 16, getting a $120 credit. You can see here that the price went a little bit up and down, but then rallied definitively, so this trade is in a good position. A caveat is that my short strike has been breached with the with FCX trading at about $56. It's trading above my short strike of 55. So I have two options here. One of them is I close the trade and I net a profit, and the other option is I try to roll out and up my short call. Since FCX is in a really good position, when I look at this chart, I still like what I see, so I will try to roll out and up and try to potentially unlock more premium here. One thing I would like to note is that I usually like to move my stop loss up. So in my initial position, my stop loss was somewhere around here, somewhere around 51. But since it has rallied higher, I now consider invalidation at around $54. So if it would drop and come below $54, I would normally close this position for either a profit or loss. It depends on the passage of time and the type of movements that I have done until then. So here we have FCX, and we can see that we have the position I have on. We have 3 times the March 48 calls, and we are selling 2 times the January 55 calls. We can see we have unlimited profit potential for the upside, and our total risk is the price that we paid for the calls. We can see that the 55 calls are now trading for about $2.10, and my objective would be to try to roll them out and up. I am looking normally to roll them out either to January 30th or February 6th, so about 15 to 30 days out is what I like to look at. In this case, I like the February 6th, and I would like to try to roll them out to the 57s. what happens is that if I roll a 55 to 57, I'm unlocking $200 in profit per call. Since I'm rolling 2 calls, I'm unlocking $400 in profit if the price is closing above 57. Why? Well, my short calls are essentially capping the max profit that I can have, right? So if I have a 55, it means anything above 55, I'm not earning that. But now if I roll a 55 to 57, I'm unlocking $2 in profit. So if I have 2 contracts, 100 shares per contract, in total I'm unlocking $400 in profit. On top of it, you can see that the 55s are trading for about $2.10 and the 57s are trading here, maybe will be trading for about $2.30-40. So I can make on the 2 contracts about $40 to $50 in credit. So on top of unlocking some profit, I can also make a credit on top of it. So that's the type of adjustments that I like to do in these positions. So that's how I trade my ratio call diagonals. This is one of my favorite directional strategies. It is almost the only one that I use nowadays. And I think this is a good combination of still getting a credit and still have your theta working for you, while at the same time unlocking a directional potential that I think is critical for us as retail options traders to also get that positive drift and to be able to capture those market movements into our portfolio, not only by selling options, but sometimes buying options can also be suitable. Let me know if you have some questions or if you'd like to get any more details. I'm happy to answer any questions. Please subscribe and hit the like button. Thank you guys.